So Fortress is proposing changing its dual share structure. Why? Well, you're going to find out in just a little bit. It's certainly an idea whose time has come. With us today to help us through the very complex issues that need to be discussed are Robin Lockhart-Ross, the chair of Fortress. The chief executive of the company is Stephen Brown, and chief financial officer is Ian Foster. Onto the advisors, Peter Bradshaw is a director at DLA Piper, and Andrew Brooking is the founding partner at Java Capital. So let's kick it all off with Stephen Brown, Chief Executive of Fortress. A bit of a history lesson, if you don't mind, Stephen. How do these dual shares exist in the first place? They're causing lots of trouble for you right now. What's the origin of the dual shares?
So it was something that came about really to split the risk profile of, in those days it was a property loan stock, so it was really a linked unit. It was a debenture and a share. And how they came about was, it was a different time, inflation was much higher, and there was more of a growth mindset. But the investors were struggling with property and its bond-like nature, so what a lot of the clever guys at the time started to do is they split out the A shares, which had a higher yield and lower growth, and the B shares, which had a lower yield but got the residual income, so therefore higher growth in a higher growth environment. And they were really quite fashionable at the time. I recall I was an analyst in 2008, and looking at these, I think one of the funds actually had an A, B and a C share. So they really took it to the nth degree, but that was really the history of it. It was different risk profiles to try and attract more capital into the sector.
So when you talk about the clever people, you're referring to people like Andrew Brooking. Because really, I mean, what they're trying to undo now is entirely your life's work, really. It's the stuff that you set up in order to deal with the problem of debt sitting within the structures, and in order to deal with the problem of differentiated growth profiles.
Yes, Bruce. Steve made the point that these dual shares, and there was a triple share, that was the old Apex High, which the late Gerald Leisner was the proponent of. But these multiple classes of shares in property income or REIT vehicles, they did serve to enable these companies to access more equity. So they were fundamentally commercial, but the splitting up of the risk and the reward was an experiment. And it worked in a different time, and it doesn't work in an economy where there is a lower growth reality. So what was somewhat experimental worked for a while and doesn't work anymore, in my view.
Okay, Robin Lockhart-Ross, you're the chair of Fortress. I mean, you've got this proposal to shareholders, and you're saying, please go along with the scheme that we are proposing. This scheme, which we'll get into in just a moment, this scheme is in your own best interests. Please vote yes. There will be some that will look at the proposal and say, hold on a second, I feel like the turkey that's voting for Christmas. What's the proposal?
Well, as you've heard, Bruce, we've got an outdated capital structure, and we've got a problematic memorandum of incorporation, which limits our ability to make distributions in certain circumstances, and we'll get into that later on. And so essentially our proposal is to collapse the dual share structure and only then have one share in issue, collapsing the dual structure by buying back the A shares in return for B shares. So the problem that we've envisaged for a couple of years now, and I go back about 3 years, was that our capital structure posed a major risk for Fortress in a slowing South African growth environment. We also foresaw the possibility that the rate of growth in the economy, and hence in our underlying property portfolio, would be overtaken by the growth in the annual A distributions. So about 2 years ago, before the advent of COVID, we established a special board subcommittee with a mandate to engage with major shareholders and embark on an initiative towards simplification of our capital structure. That was probably February, March 2 years ago, and then COVID hit. And COVID had two implications. One, that inflection point at which the A distributions and the underlying growth in the property portfolio was brought forward by COVID. And secondly, the ability for us to actually go and collapse the structure at the time was thrown into disarray because of where capital markets went. So
and capital markets aren't going to get any tidier anytime soon. I mean, we've got global inflation sitting at 40-year highs. We've got interest rates rising to a point we don't know where it will stop, how long they will stay elevated, how quickly inflation will taper. We're into a period at least of 2 or 3 years, possibly, of great uncertainty.
Yes, we are. So in March 2020, when we parked the initiative, we said to our shareholders that we would come back to it when circumstances would be more appropriate. And we set a couple of criteria for that. And one would be that capital markets were perhaps more stable than they were in March 2020. Maybe a little bit better. That there'll be more line of sight around our earnings, and perhaps then when share prices will be more reflective of the relative value of the ASB. So clearly there still remains a high level of uncertainty around that, but it's better than it was in 2020. So that was the one side of it. And the second side of it was around when we'd come back to it, when shareholders had more appetite and more willingness to look at a collapse of the share structure. And certainly we're now finding we're at a point where a lot of our shareholders are still confused by our complex structure and the complexities of our MOR. Some are irritated by the fact that over the last couple of years, what we've had to do is put a patch on our MOR, a 1-year patch, in order to maintain our REIT status. And we've now got some shareholders demanding that the board comes back and shows some leadership and put a long-term permanent solution to the problem on the table, and that's what we're doing now.
The REIT structure is really important, isn't it? I mean, Ian Forster, when we look at the REIT structure, the status of maintaining the REIT, the Real Estate Investment Trust structure, it's absolutely critical from a tax perspective that is maintained, correct?
Yeah, it's a fantastic tax structure, a REIT, having REIT status. So what that means is that a REIT, to the extent it pays a distribution to shareholders, it enjoys a deduction of that distribution. So by all accounts, it is this very, very tax efficient, tax neutral vehicle that doesn't suffer any capital gains tax, and without it, almost immediately we've become a taxpayer.
I like the term of suffer capital gains. It's a good term. Andrew, you want to add to that?
Yeah, Bruce, from a corporate finance perspective, I wouldn't say that it is an imperative that the company retains its REIT status, because I think it's a company in good shape with solid quality earnings. If it paid a little bit of tax and retained earnings and built up its balance sheet, I think that would not be a bad outcome in the interests of long-term investors.
Okay, but I mean, clearly, I think what you're trying to do, Steve, is hold on to the REIT structure. It's not the end of the world if it falls apart, but you want to hold on to the REIT structure, don't you?
Sure. I mean, I definitely don't think it's some kind of death sentence for the company. It doesn't put us into purgatory. But when we've looked at it, it's really in the best interest of shareholders of both classes and of the company to maintain REIT status.
If you lose it, what happens?
If you lose it, you as Ian mentioned, you become a taxpayer immediately, and we would then have to pay income tax on all of our income, and shareholders would then have a post-tax distribution, which obviously if you're a pensioner with a low marginal tax rate, or you're a pension fund with a tax exemption, you then are getting an after-tax amount. So I don't think there's a winner in that scenario between the company and its shareholders. I think maintaining REIT status is definitely in our best interest, and certainly that of the shareholders as a group.
And I mean, when it comes to maintaining that tax status, and particularly pensioners have traditionally loved property assets because they've been assured of the income, and that has got a bit choppier over time. But I mean, the being able to sort of put on the billboard, on the advertising, if you like, that there is a tax incentive in here is quite a useful sales pitch, isn't it?
Yeah, absolutely, and that's what the REIT machine's been designed to do. It's originally it was a pass-through vehicle, collect rental income, deduct fund costs and interest charges, and then pass the net amount through to shareholders in a very, very tax efficient way. The problem for Fortress is if we were to lose REIT status and then suffer the income tax charge as well, it's a cost to the business that one couldn't ignore in determining what is distributable earnings. And with our impediment in the MOR, or prohibition in the MRI, if we don't reach the A benchmark, we are unable to pay an A shareholder. And in determining that distributable earnings amount with the tax charge, it will just make it that much more difficult to pay distributions to shareholders.
Robert?
Bruce, look, I think one of the things to bear in mind as well is that the success and the growth of REIT depends on the ability to access capital over time. Now, the reality is we have difficulty at the moment with our capital structure and our MRR of actually accessing capital in terms of actually equity in the market. My worry would be if we lost our REIT status, it feels to be a bit like kind of being relegated from the Premier League and being down in the Championship. You'd lose access to those investors, kind of or you lose access to, or they lose interest in you. And it's essential for us to be able to continue to access capital in order to grow this business over time. We lost REIT status. What we'd have to do is we'd have to retain earnings, not make distributions, as the only means of accessing the capital that we need to grow.
Peter, let's just look about the Fortress A benchmark. Now, the benchmark is the great stumbling block, isn't it? Because if you don't make enough earnings, then nobody with a B share can be paid. So the benchmark is absolutely pivotal to the discussion. I think in the discussion that shareholders are interested in, they want to know what the difference is between A and B and why that benchmark exists and what happens when the benchmark falls away, and of course the ratios that get brought into play. But first, let's talk about the benchmark and why it's important.
Yeah, thanks, Bruce. I think you mentioned it's important to the Bs. It's just as important to the As. And perhaps there's some misunderstanding in the market, but the MOI is clear that until earnings reach the benchmark, the board doesn't have the power to declare a distribution to the As. On top of that, before you've paid a full distribution to the As, the board doesn't have the power to pay a distribution to the Bs. The benchmark's important because in the prior structure, Steve spoke about the linked unit structure, and that had a debenture element to it. And I know it's not speaking English, but effectively when the instrument had a debt component to it, the holder of the instrument had an outright entitlement to be paid. When in 2015 the structure was converted from a linked unit structure into an equity structure, why? So that the company could maintain REIT status, as we've discussed. By its nature, the moment it became equity, a holder lost an outright entitlement to be paid. And one other thing happened at the time. The entitlement of a debenture holder to every rand of income up to the threshold, if you were an A debenture holder, was changed. And so now as an A shareholder, you don't have a right, if the board decides to declare a distribution, to every rand of income up to the benchmark. You are entitled to an amount equal to the benchmark.
Okay.
So if earnings are below the benchmark, the board does not have the power to make a distribution of that income. And yet on the other side, in order to maintain REIT status, one needs to distribute that income.
This sounds like lawyer's paradise. It really does. Andrew?
Bruce, there's a long history to experimental capital structures in the listed property sector. Because
what you're saying is in property, people have ducked and dived for decades to avoid paying tax.
What happened in the early 80s was that this concept of a linked unit, a debenture plus a share, was created as a way to minimize tax or avoid tax within the corporate. That structure itself was an experiment that worked for a while and then failed in the sense that the revenue authorities and National Treasury required a permanent solution, and that led over several years to the negotiation of a REIT dispensation. When the REIT dispensation came in, all of the property loan stock companies that had linked units in issue had to convert from what they were used to a REIT structure, and that meant they had to switch debentures into equity.
Okay.
And that's given rise to actually a number of unanticipated consequences, including, in some respects, what we're facing and solving today.
Peter, when we look, there's some speculation that the board could end up paying an amount less than the Fortress A benchmark into the future. Now that's obviously, if you're a Fortress A shareholder, you're going to be a bit concerned about that.
Well, I think if you're a Fortress A shareholder who remembers the days of being a Fortress debenture holder, then perhaps that is what you expect.
Because that's pre-2015,
Because
right?
pre-2015, if you held a debenture, you were entitled to, as an A debenture holder, all the earnings below the benchmark. And the benchmark was important then because it determined what do the A's get and what do the B's get. The difference now, as an A shareholder, is you don't have an entitlement if the board wanted to declare a dividend. In fact, the board may not declare a dividend of income below the benchmark. So it's a change in scenario that perhaps not all A debenture holders appreciated, and I think it's taken time for shareholders to understand the structure. It is complicated. As a lawyer, it's complicated. Drafted by lawyers, but it is complicated, and so one has sympathy for someone who either doesn't have the time or the inclination to work through all of the documentation.
Okay, let's cut right to the chase. Let's cut right to the chase here. You are proposing a change in the way in which people are remunerated for the risk that they prepare to take on you, and you're saying we're going to do a split between A and B shareholders. There's going to be a ratio, and we're going to do a ratio of 3 to 1. Was it 4 to 1?
3.01.
3.01. Please explain, maybe this one's for you.
No, it's a very...
in terms of what the split is that you're proposing and why it is that you're proposing the split, because everybody, of course, wants to come out of this feeling like they've been treated fairly.
Yeah, it's a very good question. So 3 to 1 versus 4 to 1. The proposal is an 80-20 split. So 80% of the economics post the transaction will reside with the A shareholders and 20% with the B shareholders. When you translate that into a ratio, it translates into a 3.01 a ratio in favor of the A's. So 3.01 B shares given to every one A shareholder. Given that there are different numbers of shares in the A camp and in the B camp. Further complexity to that is that there are about 128 million B shares that we refer to them as BEE shares. They were funded by the company by way of a preference share, and 3 years ago at an approximate price of 12 Rand and 9 cents, and virtually anything under that they don't share in the dividend flow and so on. So they're almost treasury-like in the economics of distributions and so on that the company pays.
But the goal here is to have an A share and a B share that is a single share, and yes, everybody is treated equally. It is at the point of merging the two classes of share that you have to get this proportionality absolutely spot on so that it is completely equitable across the board.
Correct.
Andrew, why is this the correct formula?
Bruce, there's an objective methodology that results in a conclusion that the 80-20 split is the most defensible split of the future economics. How did we get to that methodology? Firstly, we had the benefit of engaging with a very wide range of shareholders in both camps. Secondly, in the end, it's about the distribution rights. This company is set up to distribute as a REIT. If it ceases to be a REIT, the intention would be to retain earnings, or the logic would dictate that it retains earnings. So where we are is that for the 22 and 23 years, the company has published guidance that indicates that it will not meet the threshold which allows it to pay dividends.
Right.
That means it's not going to meet its payout obligations, which are the obligations it needs to meet to continue to be a REIT. Which means we're coming to a crossroads here. And the crossroads is, unless there is a shareholder-approved solution which gives it an alternative path, the path it is on will result in it losing its REIT status.
What's the time frame on that?
Is
there a big steam train coming?
We are currently in injury time,
okay,
and we need a resolution. We need a resolution by October.
Okay. So it's got to happen quickly. Robert,
31st of October is the date.
31st of October is deadline.
That's the date we ought to pay a distribution.
And if you don't meet that 31st of October deadline, the REIT structure falls away automatically.
Yes.
And it's game over in terms of the REIT structure.
Bruce, I hesitate to say automatically, but the JSE listings requirements are clear.
Okay.
You lose the REIT status if you don't meet the payout obligation. Now this hasn't happened before, so we're in unprecedented territory.
Okay. Why should your shareholders support you on this one, Robin?
As a long-term solution, a single share structure is a sustainable, permanent outcome for the company. The difficulty, obviously, is what's a fair and reasonable swap ratio. Now, if you're an A shareholder and you're a B shareholder, you might have very different expectations. You know, the A's might have an expectation around, let's say, 4-1 or 5-1 might be fair, and the B's might have 1-1 or 2.1. And that's our difficulty.
Andrew used the word defensible.
Yes.
It's defensible.
Yes. And
does that mean it's equitable?
No,
because they're two different things.
I think the issue here is we have to put out something that is fair and reasonable.
Yeah.
In terms of our circular, you know, we get experts like Andrew to go and do an objective analysis and run scenarios and do a whole lot of present value calculations. We'll have to get a third-party expert to come in and determine whether it's fair and reasonable. And we believe, and the difficulty is obviously is pinning a particular ratio. We've pinned a ratio of 3.01. Clearly, what's fair and reasonable would lie within a range. Pick a number. Yeah. 2.75 to 3.25, 2.5 to 3.5. Call it whatever the range is. The difficulty is, and I think we can come up with Andrew used the word defensible, we could come up with an objectively defensible rationale for why we came up with 3.01. The big issue for me is not whether the scheme is fair and reasonable, it's going to be whether it's palatable. And what's palatable to an A shareholder might not be the same as what's palatable to a B shareholder.
If everybody's equally unhappy, perhaps then you've hit the sweet spot.
I think you've hit the nail on the head there.
Steve?
No, I just want to add, Bruce, that, you know, Robin's absolutely correct. I think when we get feedback from shareholders, this capital structure dominates the conversation. Yeah. I think we've got a fantastic business, which has got a great future, but shareholders like the simplicity and they like the flexibility of a single share structure. I think
it's quite old-fashioned, and the rest of the industry has moved away from the dual share structure.
Yes.
Absolutely. Internationally, you know, in the US, where really the sort of REIT model was really born, they don't have these type of structures. You know, you look at the big REITs like the telco REITs, Prologis, Simon, they all have a single share. It's very flexible, and I think the shareholders that we've engaged with agree that a single share for Fortress is definitely the best outcome. So once we've got them to agree on the destination, I think that's been the hardest part of the job. Now we just need to get them there.
Okay, thanks, Stephen. I mean, when we look at this, Robin, in terms of timing, we spoke about market uncertainties, and you shelved this idea in February of 2020 when the world was falling apart. Things are still desperately uncertain. Why, in your view, is the timing of this decision now before the 31st of October so pivotal?
Well, Bruce, I think Andrew used the point and had we come into an inflection point, and I think that's right. No, so as I said to you earlier, there's general consensus among shareholders that we should move towards a single share structure over a period of time. And the difficulty, as I said to you, is around an exchange ratio. Some shareholders have questioned whether now is the right time to do it. The reality is, now that we're reaching that inflection point where if we do nothing before the 31st of October, we will lose our REIT status. In the last 2 financial years, we've made one-off temporary amendments to the MRI in order to enable us to keep our REIT status. I think what's happened now is shareholders have lost patience with temporary patches, and quite frankly, as a board, we've lost patience with temporary. We want to fix this.
You end up focusing on the wrong sort of stuff. You're having this conversation rather than a growth conversation, rather than an opportunity-driven conversation.
Yeah, you know, the reality is people out there talk about it being a distraction. It's a distraction for management for sure, and it's a distraction for the board. The reality is we spend an inordinate proportion of time at our board meetings talking about the capital structure and the distribution policy and all of those things, where we really should be focusing on the growth of the business and the strategy of the business. And we feel that at a board level, management feel it even more at their level.
Let's put vested interests aside for a moment here, because where are management incentivized? I know there's a question from at least one shareholder within A or B shares, because that could affect support of one ratio versus another ratio, for example.
So the simple answer to that is in both, Bruce. There have been various in various iterations of our long-term incentive scheme over a period of time. In fact, we've got 3 in place at the moment. The first one is actually closed. The second one runs out in a couple of years' time, and the third scheme was put in place 2 years ago. All of those, under all of those, management incentivized in terms of equal number of A and B shares.
Okay.
So if the annual incentive is derived as X, we backsolve the number of shares to make sure that management get equal number of A and B shares.
Okay.
It doesn't mean they've got equal value, but they have equal number of A shares.
There's an additional protection for shareholders in the scheme mechanism that's being used. Management actually don't end up having a say, because this is a proposal by the board excluding management and shareholders.
So even though they're shareholders,
well, they can have a vote,
They
but
can have a vote,
they're
but
not
not a
making the
say.
proposal.
Right, good.
The board made up of the non-executives took the decision to make the proposal.
Okay.
And the proposal gets put to shareholders who have a say. It's their constitution. They get to decide what the constitution says. And management don't have a say in what gets put to the shareholders.
Andrew?
I just wanted to make the point, Bruce, that in disclosing the management exposure to both A and B shares, it is evident that management is overweight value-wise in their exposure to the A shares. That will be disclosed in a circular that will come in due course.
Is there a value unlock? Is there an incentive beyond losing the REIT status? So that's the stick. Is there a carrot anywhere in this patch?
Yeah, Bruce, there are lots of carrots. I mean, we've heard mention of the management and board distraction and the benefits of focusing on the business rather than the capital structure. But the complexity and the uncertainty that follows from this outdated capital structure is a loss of value in terms of how the shares are priced relative to the intrinsic value of the business. You can estimate that on many which ways, but our estimate, 3.5–4 billion rand, would be of the order of value unlock that would again be defensible if the solution is approved by shareholders.
Okay. Ian, next steps, final steps, last question to you. What are the next steps in order to get this deal across the finishing line on time?
As Andrew's mentioned, there'll be a circular in due course. I think...
Please don't post it. Please, don't post it. That's what you used to do in the olden days when the scheme was devised.
It's posted and emailed. No, there'll be a circular in due course and a vote to follow in mid-August. And shareholders can decide then.
Excellent. Okay, last word, Stephen.
And then hopefully a dividend.
Then hopefully a dividend.
Then hopefully a dividend.
Because if it's not decided
that's what
on,
everybody's been hoping for. So if
Exactly.
that passes, then there'll be a dividend before the end of October.
The point about the dividend is no small point in relation to the value unlock question that you asked.
Right.
Because if there's a solution which keeps this company as a dividend-paying REIT, it's 2 dividends for 2 full financial years in about 14 months. That's a lot of cash flow to shareholders if they get to approve the solution.
There's the carrot. Nobody for any more? Going, gone. I know this is an auction, but we're done. Thank you very much, gentlemen, indeed, for giving us some deep insight into the proposal that has been put to you, and it's up to you to vote. Once the circular's out, it'll be in your inbox, email, not by post.